Your retirement savings just became a high-stakes casino, and most people have no idea what they're walking into. A groundbreaking executive order recently signed by President Trump, titled Democratizing Access to Alternative Investments for 401k Investors, is about to revolutionize how Americans can invest their retirement money. But here's where it gets controversial. This could either make you wealthy or completely wipe out your nest egg. Kathryn McCall, a seasoned financial advisor and vice president at CapTrust, recently broke down what this sweeping change means for everyday investors. According to McCall, this order essentially throws open the doors to investment options that were previously locked away for regular 401k participants. So what exactly are these alternative investments everyone's talking about? Think beyond traditional stocks and bonds. We're talking about private equity firms that buy and restructure companies behind closed doors. Private credit opportunities that lend money to businesses you've never heard of. Real estate investment trusts that own everything from shopping malls to apartment complexes. And yes, cryptocurrencies like Bitcoin. The scope also extends to commodities such as oil and gas partnerships, precious metals, and other non-traditional investment vehicles that operate outside the typical public market structure. But here's the part most people miss. Many of these investments carry significantly higher risk profiles than what you typically find in a standard 401k menu. The Bitcoin gamble, fortune or financial ruin. McCall points out that President Trump's well-documented enthusiasm for Bitcoin is a driving force behind this initiative. The president has a genuine passion for cryptocurrency and recognizes that 401k plans represent an enormous pool of capital, trillions of dollars, that could potentially flow into Bitcoin and other digital assets, she explains. The appeal is obvious. Bitcoin has delivered spectacular returns for some investors, creating stories of overnight millionaires that capture headlines and imagination. However, and this is crucial, cryptocurrency investments have also demonstrated the capacity for complete and total loss of principal. We're not talking about market downturns where you might lose 20% or 30% of your investment. We're talking about scenarios where your entire investment could evaporate to zero. This creates a massive dilemma for employers who sponsor 401k plans. Under federal law, these companies have what's called a fiduciary duty to their employees, meaning they're legally obligated to act in their workers' best financial interests when selecting investment options. Including highly volatile assets like Bitcoin in a 401k menu could expose employers to significant legal liability if employees suffer major losses. The private market gold rush, opportunity or trap. Private equity and private credit investments represent another fascinating aspect of this executive order. Historically, these investment strategies were the exclusive playground of ultra-high net worth individuals and institutional investors like pension funds and university endowments. The numbers tell a compelling story about why this matters. Currently, only approximately 4,000 companies trade on public stock exchanges in the United States. Meanwhile, roughly 25 million companies operate as private entities. This means the vast majority of American businesses, and potentially the most innovative and fastest growing ones, have been completely inaccessible to typical retirement savers. The private market has expanded dramatically in recent years, partly because fewer companies choose to go public through initial public offerings. Many businesses now prefer to remain private longer, accessing capital through private equity firms and private credit providers instead of public markets. However, these investments come with significant drawbacks that could shock unprepared investors. Unlike publicly traded stocks that you can sell within seconds during market hours, private investments are notoriously illiquid. You might only be able to access your money on a quarterly basis, or in some cases, your capital could be locked up for years. Additionally, private investments typically charge substantially higher management fees compared to public market alternatives. While a typical mutual fund might charge 0.5% to 1.0% annually, Private equity funds often charge 2% management fees plus 20% of any profits generated. The complexity factor cannot be overstated either. These investment structures often involve intricate legal agreements, complex fee arrangements, and business models that can be difficult for non-professional investors to fully comprehend. Warren Buffett's warning that everyone should heed. McCall references legendary investor Warren Buffett's timeless advice. If you don't understand an investment, you have no business being in that investment. This wisdom becomes particularly relevant when we're discussing retirement savings. Money that represents your entire financial future and security in later life. The stakes couldn't be higher. Unlike a separate brokerage account where you might experiment with small amounts of fun money, your 401k represents the foundation of your retirement security. Making poorly informed decisions in this account could have devastating long-term consequences. The regulatory reality check. So why haven't these alternative investments been available in 401k plans until now? The answer lies in regulation and legal requirements. Many alternative investments operate with significantly less regulatory oversight compared to publicly traded securities. Private companies don't face the same disclosure requirements, financial reporting standards, or regulatory scrutiny that public companies must navigate. Under ERISA, the Employee Retirement Income Security Act, the federal law governing employer-sponsored retirement plans, plan sponsors must ensure that investment options meet specific criteria for being qualified and suitable investments that serve participants' best interests. Until recently, most alternative investments simply didn't meet these stringent standards. This executive order is essentially challenging that regulatory framework, potentially opening the door for investments that were previously considered too risky or unsuitable for retirement accounts. The controversy that's splitting financial experts. Here's where things get really interesting and divisive. Financial professionals are deeply split on whether this development represents a democratizing breakthrough or a recipe for disaster. Proponents argue that excluding working-class Americans from the same investment opportunities available to the wealthy is fundamentally unfair. They contend that sophisticated investors shouldn't have a monopoly on potentially lucrative private market investments. Critics, however, worry that we're about to witness regular employees gambling with their retirement security using investment vehicles they don't fully understand, potentially leading to widespread financial devastation. What this means for your financial future. As this executive order begins to take effect, employers will need to carefully evaluate which, if any, alternative investments to include in their 401k menus. The liability concerns are substantial, and companies will likely proceed cautiously. For individual investors, this development demands serious self-reflection about risk tolerance, investment knowledge, and retirement timeline. The opportunity for enhanced returns exists, but so does the potential for significant losses. The question isn't whether you should or shouldn't invest in alternatives. It's whether you truly understand what you're getting into and whether these investments align with your overall retirement strategy. The bottom line question that everyone's avoiding. Here's the uncomfortable truth that nobody wants to discuss. Are we about to witness the greatest expansion of retirement investment opportunities in decades? Or are we setting up millions of Americans for financial catastrophe? The answer might depend entirely on education, proper implementation, and whether employers can successfully balance opportunity with responsibility. What do you think? Is opening up these alternative investments to 401k participants a long overdue leveling of the playing field? Or are we about to watch ordinary Americans lose their retirement savings in investments they don't understand? Should there be limits on how much of your 401k can go into these high-risk alternatives? Or should adults have complete freedom to make their own investment choices, regardless of the consequences? This debate is just getting started, and the stakes couldn't be higher for millions of American workers approaching retirement.